The US stock market has been remarkably tranquil this summer, and that has sparked a predictable spate of concerns that investors are complacently marching lemming-like towards a cliff. And there are reasons for disquiet. Despite the lackluster earnings backdrop, the S&P 500 forward price-to-earnings ratio is near a 14-year high. The median stock trades at a record PE ratio of 21 times. That surpasses even the highs of the dot-com boom. With the summer doldrums coming to an end, predictions of an imminent correction are proliferating. And one obvious trigger would be the Federal Reserve. The US Central Bank put investors on notice for another interest rate increase later this month. That has contributed to the recent weakness in the stock market. And despite the soft factory data out on Thursday, strong employment data tomorrow could cement that case. And given that investors are only pricing in a roughly 32% chance of a hike, the potential for an upset is real. Still, markets are adept at climbing the proverbial wall of worry, and subdued volatility doesn't mechanically mean that markets are heading for a crash. And some untraditional gauges of the equity outlook are actually more positive. Take, for example, Wall Street strategists, who are increasingly pessimistic. That is actually a reliable contrarian indicator. Indeed, Bank of America Merrill Lynch's index of analyst sentiment fell to its lowest level in 3 years in August. Equity returns have historically always been positive in the 12 months following such a subdued reading. Below the surface of the superficially supine stock market, there's also been a rotation from defensive industries like pharma and utilities to more cyclical ones like banks and electronics. SocGen's Andrew Lapthorne reckons this is a sign of improving investor optimism on economic growth. And even if there is a stock market squall, it will probably be short-lived. While the Fed is prepared to temper the party by adding some mixer to the monetary punch bowl, other central banks are still busy spiking it with sake, gin, and Jägermeister. Any severe market ructions are also likely to move the Fed back to the sidelines as well. In other words, the buy-the-dip investment strategy that has reigned since the financial crisis will probably continue to do well. The bears will have their day, but not yet.